What's up guys, welcome back to another video. I hope you're all doing well, as today we are going to talk about a company which you most likely all know, and that is McDonald's, or as I like to call it, the surprise box of restaurants. But before we start, I however have to say I'm not a financial advisor, and this is made for pure entertainment. But as per usual, let's start out with the introduction. McDonald's is a consumer company which focuses on operating and franchising restaurants, which includes various food and fast food products. They are headquartered in the US, or to be specific, in Chicago. However, I honestly have to say that McDonald's isn't really a consumer company, if you ask me. But more on that later on. For now, let's have a look at the key financials which they bring to the table. As per usual, let's start out with the company's market cap, which currently sits at right about 160.8 billion, making McDonald's obviously one of the bigger companies out there. But obviously, this valuation does not come out of thin air, and can somewhat be attributed to the revenue of the year of 2019, which sat at right about 21 billion US dollars. However, let's break that revenue down a little bit further, so we can already get a brief overview of what makes McDonald's money to what extent. This is fairly easy for the case of McDonald's, as they only differentiate between two things, and these are the revenue from company-operated restaurants and revenues from franchised restaurants. When you now, however, consider that 93% of McDonald's restaurants are franchised, you can already see that the margins for company-operated restaurants are far greater. But enough with the introduction, which we now have knocked out of the way. Let's move on to something which you probably all want to know about, which are the distributions to shareholders. At the current point of time, McDonald's returns capital to shareholders through dividend and share buybacks. However, at first, let's focus on the dividend, which currently sits at right about $5, equaling a current yield of about 2.31%. But while we've now talked about the current distributions, let's also have a look at the past distribution history, as this can indicate how focused on the dividend a company actually is. For the case of McDonald's, we are able to recreate the dividend up to the year of 1976, which is the year McDonald's decided to start paying a dividend. This is also right about the time since which McDonald's decided to follow a strict dividend policy of constant increases up to this date. When it now comes to stock buybacks, these aren't that constant. However, it must be said that these contribute a ton to the total distributions in the recent years. But in order to figure out how much McDonald's actually distributes to their shareholders and how sustainable these distributions are, let's put the total distributions into contrast with the free cash flow. Right from the bat, we are able to see that there isn't really a constantly increasing rate of free cash flow, as it bottoms out in 2017 and then jumps up again. When it now comes to the distributions, this is also all over the board if you ask me. What however bothers me especially is the rate at which the distributions exceed the company's free cash flow. While this might be a thing which you can do in the short term, this is absolutely no long-term play, and means that McDonald's has to actually take on that in order to cover their distributions. And I don't think that I have to say that this is not great. But let's also have a look at the balance sheet in order to evaluate the financial position of our company even further. As per usual, let's start out with the year of 2015, in which McDonald's total assets sat at about 37.9 billion US dollars. These were made up by about 9.6 billion in equity, 24.1 billion in long-term debt, $0 in current debt, and 4.1 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using the company's debt and its cash position. For the case of McDonald's, this sits at 16.4 billion US dollars. But let's set that value to the side for now and get back to it in just a second. As you are able to see, McDonald's total assets increased to about 47.5 billion. This is made up by about 3.5 billion in equity, 34.1 billion in long-term debt, 59 million in current debt, and 9.7 billion in non-interest paying capital. But now, let's calculate the net debt like we did for the year of 2015. This time, however, we get a net debt of 33.2 billion, which is already a somewhat decent increase if you ask me. But let's also find out how sustainable the debt which we just calculated, actually is, and whether the debt has gotten better or worse. This is done using the EBITDA, which is the pre-tax, pre-interest, pre-depreciation, pre-amortization income of said company. After doing our basic calculations, we are left with a sustainability of 1.88 or 188% for the year of 2015 and 3.1 or 310% in 2019. This indicates to us that the debt has actually gotten less sustainable and is at a point where I would consider it somewhat unsustainable. Alright, since we now have the financials settled, let's get our margin of safety by collecting arguments for and against the company. This is extremely important for the case of McDonald's since we have to settle some things about the company. First of all, let's start out with the obvious stuff, and that is that McDonald's pretty much is the most recognizable restaurant brand all over the world. May it be a person in China, a person in India, or a person in France. When you ask them about fast food, they most likely will all mention McDonald's at some point. And if you ask me, to even achieve this brand status as a food chain, you have to do a whole lot of pretty good marketing. Therefore, I'm going to reduce my margin of safety by about 5%. However, you also have to note that from this alone, a certain market power is born, which allows McDonald's to take direct influence on their suppliers. The best example for this is the ongoing deal between McDonald's and Coca-Cola, in which McDonald's received the right to be the restaurant with the lowest Coke prices on the market. This obviously is great as they can reduce the pressure that competitors are able to put on them by themselves pretty easily. Therefore, I'm going to reduce my margin of safety by another 10%. But now, let's get to the, in my opinion, most convincing argument for an investment in McDonald's. And that is that McDonald's is more than just burgers and even way more than food in general. But what do I mean by this? Well, first of all, we obviously have the previously mentioned fact that everybody knows McDonald's. And in 5 of McDonald's markets, round about 75% of the population live within 3 miles of a McDonald's. This means that the company has an insane coverage of landmass with their 37,855 branches. But let me clear the smoke for you. As a part of their business strategy, McDonald's owns all of the real estate which their branches are set up on. This includes company-operated branches which are simply treated as restaurants. When it now, however, comes to franchise stores, these pay a fee for the franchising and pay rent for being allowed to use the real estate of McDonald's, which actually makes rents a major source of income for McDonald's, allowing them to somewhat hedge their risk of allowing franchisers to set up shop. While this in itself is already extremely great and shows us that McDonald's is more than just food, it in my opinion makes them a somewhat REIT with benefits obviously, which in my opinion also somewhat makes their debt a little bit more reasonable. For this reason, I will reduce my margin of safety by another 15%. However, I also have to admit that it is not all perfect either, and I personally think that the franchising can be seen in a pretty positive way, which however has some downsides. For example, that one branch can cost McDonald's a fairly big reputational damage. But what is somewhat more important in my opinion is it costs McDonald's a ton of money. However, even when adding 5% to my margin of safety for this fact, it still lands at 0%. Since the safety margin is 0% for the case of McDonald's, we are going to skip the usual part with the fair price and skip forward to the buy price. To now get this, all we have to do is get the average dividend yield of the past 10 years, which sits at 2.82%. With the safety margin of 0%, this gives us a target yield of 2.82%. With which my personal buy price per share of the company would sit at $177.30. Overall, I would currently say that McDonald's is a great company, which however is trading at too high of a price for me. Therefore, McDonald's currently is a hold for me, with a fairly high dividend which could become somewhat unsustainable in the near future. This was Might as well, and I'll see you in the next one.